Welcome back, guys. Today I will be talking about Jumia Technologies. Jumia Technologies is one of the biggest e commerce platforms in the continent of Africa. We'll be talking about whether or not I see scope in this company and whether or not it can rebound from its pre IPO prices. So let's get started. So, as we see, Jumia Technologies is down around 5% today. It's down around 9% on the 1 week chart. It's up around 400% on the 3 month chart, and is up around 93% from its IPO price of $20.71. So, as you see right here, there's a big dip right here where Jumia Technologies goes to around $2.50 on April 3rd, 2020, and it's rebounded all the way back up to around $40 a share, which, that's a big increase. That's like around a 2,000% increase. So there are many reasons why this happened, but more importantly, there is a reason why it went down. That's more concerning to me than the reason why it went up. So it's one piece of news which made it go up and made it go back down. The reason being was during 2019, Citron released a short seller report on Jumia Technologies and claimed that Jumia Technologies was a fraud, which is quite interesting because Citron, again, in July of 2020, claimed Jumia is not a fraud and it's one of the best opportunities for our generation to buy. It's quite interesting how in 1.5 years, one company said that Jumia Technologies was a fraud, and then the same company said it's the best buying opportunity of our lifetimes. We will look more into the report. Let's look more into the valuation basis right now. It does have a low market cap, 3.27 billion market cap. However, they were running into losses. They are still running into losses, as you can see. It's around between -30 and -90 cents, which is not too bad. However, for growth companies, we do like to see positive earnings, eventually, but it does not look like they'll have positive earnings for the next couple of years. So this is very, very interesting company because it's the largest e-commerce company in Africa. However, it was based in Berlin, Germany. So it's not officially founded in Africa, but the management staff is Berlin based. That can be both taken in a positive and negative way. Positive way is that Germany has better infrastructure and has a better HQ uh, performance overall compared to Africa. There's more and more companies out of Germany than Africa, so their management staff may be good. But the negative catalyst I see is that, hey, uh, you can't be the biggest player in that sector if you're not based in that continent. Amazon won't be the Amazon of the US if it was based in, Shanghai. So that's one thing I see, which is pretty negative. Now let's look at the Citron report that they released a couple of months ago, and I'll discuss whether or not I'll be buying the stock. So we're here in Citron Research's uh, report on Jumia. As you can see, it says the generational buy investors listen. So it's quite interesting. So as you can see on the very first slide, they did address how in May 2019, Citron exposed the problems at Jumia Technologies that included discrepancies in SEC filings, which is a very, very big red flag. Companies drop 90 to 95% just based on this. If you look at Luke and Coffee, they had some discrepancies in their SEC filings, which caused the stock to go from $50 to like two. So that's very, very that's a very big deal that Citron said that. I think at that time the price was $20 and the stock did eventually fall to $2.50. So yeah, fraudulent orders. I don't know how Citron can prove that. I saw that. I saw this when the report came out on the sell report on this. So fraudulent orders. I understand maybe there might be some discrepancies, but proving fraudulent orders is kind of hard. A company burdened with inefficiencies. Yeah, that was the main problem for me. When you say a company's inefficient, they can't be successful. In order to be successful, you have to be one of the more efficient companies out there. If you're not efficient, there's no way you can be successful. But now they're saying everything has been changed, which is quite a big stance. And they're comparing companies like Jumia to Melly, Baba, and SE. Just keep in mind, these companies are established players in their respective countries. Melly is a Mexico-based company, which is one of the biggest e-commerce platforms in Mexico. Alibaba, same thing in China, and SE is the same thing in Singapore. So we've seen returns of hundreds of thousands of percent in each of these stocks. So basically, they compared that to Jumia, and they said how it can be applied as well. Acceleration of e-commerce adoption by Nigerian consumers. I agree with that. I've seen the growth rate is right above 20%, which is really good. The renewed focus on profitability. I'm not 100% sure about that. When the CEO was live last time, they did not talk about that too much. They just said we have to increase our consumer base. I'm not concerned about profitability. I'm concerned more about people outreach. How many people are willing to pay for online products? As because Africa is still, a little bit of a conservative content, I would say they'd rather go to the store and buy it than have it shipped to them. The rapid acceptance of fintech products like Jumia Pay, I really really like that. That was one of the main reasons I invested in Alibaba was because of Alipay. Jumia Pay, if that's really successful, I would invest in the stock pretty heavily. The ability to use Jumia as a product for platform for ancillary products, that's also one very big positive I see in this company. So basically, what Citron said is that these have been corrected. These have been corrected right over here, and these are the more positive sides. And I kind of agree with that. I kind of see that e-commerce, if you are a big player in that industry, you can be very successful. I would say Africa is one of the hardest areas to tap into just because of how big it is and how vast the population is in different continents. For example, South Africa, Ethiopia, Egypt, they're very, very far away. So, the more land population based countries are all farther away. As you can see, Nigeria, Egypt, Ethiopia, and South Africa. And one thing to keep in mind is that they're not even in half of the countries in Africa. So I guess they still have to expand more, which is quite interesting. But yeah, I'm not very surprised that Citron corrected themselves because I did see this as a good opportunity to buy, especially when it hit single digits. So yeah, now let's talk about the TAM. In Citron's initial short recommendation of Jumia, the one bit of hesitation we always had was the size of the addressable market. Yes, that's a very very big issue. So like I was saying, all four of the major population areas were in all different cities. I mean, all different land masses. Excuse me. So attaching those people with their goods is very very difficult. Now I'm going to talk more into detail about the other particular stuff and whether or not I'll be buying this stock. So essentially, on this slide, Citron essentially said that they quickly shifted the purchasing habits of Africans to accept more on e-commerce type platforms due to the pandemic. However, this can be refuted very, very easily. I was looking at their percentage change in revenue. It's only 2 or 3% it's gone up. So that does concern me a ton because the pandemic was the perfect time for e-commerce platforms to explode. I believe Jumia was the only one that barely did any sort of growth. If you look in their revenue numbers and their total orders purchased, it was surprisingly low. When I compare it to Melly or SC or Amazon, which had 10 to 15 to 25% plus growth, it's quite alarming that Jumia has such a low growth rate because this report came out a couple months ago, right? Now the pandemic, it's we're almost done with it, I would say, and some of the results from March, April, May are coming out right now in their earnings, and I'm going to be quite honest, it's kind of disappointing to see how in such a perfect ideal situation for e-commerce companies they can't they can't innovate, they can't progress, which is a little bit which does trouble me a little bit. So as we see here, they basically said that they are partnering up with various companies like Nokia, Intel, HP, Nexus, Samsung, and that sort, where they can get brand recognition, not necessarily deals, but encourage to have their products at Jumia, which is quite interesting. Emerging market e-commerce. Yeah, basically they compared it to SE, which is C Limited of Singapore, and they compared it to Alibaba and sort of that type of thing. They said SEOs had a low growth rate back in the day and now has excelled. And Melly had the same thing in 2018. Well, it's very hard to determine, when companies will hit low growth through to high growth. But I would say it's pretty rare you see a company, grow 40 to 50% every year and then drop to like 2 or 3% and then come back up. There has to be a catalyst, right? And the catalyst for this year was the COVID-19 virus, right? So since they have COVID-19, a lot of people want to shop online. So it's kind of, kind of, it doesn't sit right in my mind where companies in a perfect situation can't be efficient, right? That comes into the inefficient theory as well, right? It's kind of inefficient if you can't innovate during this time. And they talk about their shift to profitability as a platform, and then they talk about their Jumia Pay and how Africa is becoming and more more and more of an e-commerce friendly continent. But I think that'll take a couple of decades at least, and there might be another more efficient company than Jumia there. The problem is I don't see any big retail companies, retail businesses like SoftBank or any hedge funds invest in Jumia. So that kind of concerns me as well. So basically in their conclusion, they wrote Citron identifies the best investments, blah blah blah. That is completely wrong. Citron is actually, in terms of the short selling, it's terrible. I'm sorry to say that, but they did a short selling report on Tesla. Tesla's 1,000% plus since. They did one on Shopify at $100. It's 1,100 now. They did one on Neo when it was like $10. It's $45 plus. I think the only thing they got right was Nicola so far this year, which everyone knew it was a pretty bad company. So let's just take this report with a grain of salt because they're not always right. More often than not, they're pretty wrong, to be honest. Forget about valuation and look more at significance. That's what I agree with. The country of Nigeria is dedicated to making e-commerce work. So one thing I don't like is that they're always focusing on the country of Nigeria. You can't expect a 20 billion valuation plus and focus on one country. Shipping over 20 million packages across 11 countries. That's positive. I'm not sure if they're benefiting from this yet. And this is correct. Jumia is at the epicenter of the movement and the only scaled e commerce player in the continent of Africa. Now, let's talk about whether or not I'll be buying this stock. So, we're here at Macro Trends looking at, basic financial technicals on Jumia stock. And one thing that does concern me is their declines in revenue and declines in overall profit. So essentially, during this pandemic, they couldn't capitalize. Like I was saying, if you see right here, it's very inconsistent revenues. I would like to see a spike, if I was a true investor, like to around, 70 million at least, so around double what it is right now due to COVID, right? That's basic expectations for an e-commerce platform that's very, very big, in Africa, but they couldn't capitalize on that, unfortunately. But I do see that they have some, maybe they can improve in the future because I do see there's a little bit of growth right here, but overall, it doesn't look too pretty for me. Their assets and liabilities are also pretty bad. I looked at their cash on hand; it's depleting, but that's COVID, so that's no problem with me. In terms of their total, cost of goods sold in 2018, 2019, 2020, it's been on a decline. Operating expenses have only increased. Income after taxes has only decreased, and earnings per share have been pretty, pretty bad throughout the company's history. So, in my opinion, right now, I will not be buying this stock. At $40, I think it's way too expensive. I think for me to even look at this stock, it would have to go below 11, $10 a share. And then, I might gamble and take 100 shares. And if it does balloon into the Amazon of Africa, I'll be sitting pretty good because either it's going to be, $1,000 plus stock, or it's going to be a $0 stock. And we'll figure that out, in 10 or 20 years when the stock, is either one of the best opportunities or one of the worst. All right, there you have it, folks. I will not be buying the stock unless it hits, my $10, $11 price target. I do believe that this stock may have potential, but I think that potential is already taken up with the stock price at the moment. I think that the Citron report is positive for the stock, but just take it with a grain of salt. Some of the things that Citron said were not true necessarily, and Citron's not the very best company to just purchase stocks on their opinion. So I hope you like this video. Please leave a thumbs up and please subscribe and have a good day.